Once in a while, not once in a decade, not once in a generation, but once in a century, the rules of who owns what get completely rewritten. It happened after World War II. Returning soldiers got low-interest mortgages, college benefits, and stable factory jobs. Suburbs were built. The American middle class was born almost from scratch. Wealth, for the first time in history, spread meaningfully beyond the aristocracy and into millions of ordinary households. That post-war boom created what we now call the greatest generation of wealth builders in history, and it is about to hand off everything it built. $124 trillion. That is the estimated value of assets, real estate, investments, businesses, savings, that will transfer from the baby boomer generation to their children and grandchildren over the next 2 decades. $124 trillion. To put that in perspective, the entire pandemic relief effort, every stimulus check, every small business loan, every vaccine program, every government intervention totaled roughly $5 trillion. This wealth transfer is 25 times that. It exceeds the combined annual economic output of every country on Earth, and it has already started. Welcome back. Today we are going deep on the most important financial story of the next 20 years, one that will affect your property values, your career, your investments, and your net worth, whether you receive a single dollar of inheritance or not. Because this isn't just about who gets what when grandma passes. This is about a complete restructuring of capital in the global economy, and if you understand it early, you can position yourself to benefit. If you ignore it, the wave passes over you and someone else catches it. Let's get into it. Right now, baby boomers, people born between 1946 and 1964, control approximately 52% of all household wealth in the United States. 52%. That is roughly $78 trillion sitting with one generation. For comparison, millennials, the largest living adult generation, currently control about 9% of household wealth. Gen X holds around 25%. The math here is staggering. The generation that created the most wealth is sitting on the vast majority of it, and they are now between 61 and 79 years old. Now, I know what some of you are thinking. This doesn't apply to me, my family doesn't have a trust fund, my parents aren't leaving me a beach house and a stock portfolio. I hear you. And here's the thing. You're right that the majority of this wealth will not come to you in a check with your name on it. But that is entirely the wrong way to think about this money. When trillions of dollars move, they don't disappear, they flow. Into real estate markets, into stock prices, into new business formation, into consumer spending patterns that reshape entire industries. This money is going to move through the economy like floodwater, and whether or not you're in the path of the water, the geography changes permanently. The smart question is not, am I getting an inheritance? The smart question is, where is the money going and how do I get in front of it? Here's a number that tells you how fast this is already happening. The United States is currently creating over 1,000 new millionaires every single day. Not through lottery wins, not through viral apps, through the slow, steady inheritance and asset appreciation machine that is already in motion. Every single day, 1,000 new households crossing the $1 million net worth threshold. That is the velocity of this transfer, and it is accelerating. All right, here is where we need to be honest about the distribution. Because $124 trillion sounds like enough for everyone, and in theory it is, but the reality of how it is spread is much more concentrated. 62% of this wealth is held by just 2% of households, the top 2%. Which means the bulk of this transfer is happening between ultra-high net worth families, and their heirs are going to wake up rich regardless of anything we discuss today. But here's what that concentration actually means for everyone else. When those heirs receive and deploy that capital, it ripples, violently and predictably. Think of it this way. An heir in Austin, Texas receives a $3 million inheritance. They buy a house, a nice one. That purchase pushes up comparable sale prices in their neighborhood. The homeowners around them see their net worth rise. Some of them sell, use the proceeds to fund a small business, hire employees. Those employees spend their salaries at local businesses. Some of those businesses expand, raise capital, create jobs. This is the cascading effect, and it happens simultaneously in hundreds of cities, in thousands of neighborhoods, across every sector of the economy. It's not one event. It is a 2-decade-long economic reshaping. This is the central insight I want you to take from this video. The people who have built lasting wealth across every generation are not the people who received the most luck or the best starting position. They are the people who owned productive assets during periods of capital movement. In the 1950s, the EM bought the empty lots before the suburbs were built. In the 1980s, the EM bought the first commercial real estate before office parks spread. In the late 1990s, the EM bought internet infrastructure, not the stocks, the physical data centers and fiber. They owned the machinery of the boom. The 2020s and 2030s EM is buying the infrastructure of the wealth transfer, the assets and positions that the capital flowing from this generational shift must flow through. One of the most significant and underreported aspects of this transfer is how the receiving generation is going to invest differently from the generating generation. Baby boomers built their wealth primarily through 3 vehicles: home ownership, pension-linked equities, think the classic 60-40 portfolio, and long-term bond holdings. This was the playbook of their era. It worked extraordinarily well for 40 years. The generations receiving this wealth are not going to replicate that playbook. Stat: 72% of Gen Z and millennial investors say they are allocating away from traditional stocks and bonds toward alternative investments, AI infrastructure, digital assets, and direct business ownership. This is not speculation. It is a documented and accelerating reallocation. The AI connection. This is where the AI story we covered in a previous video connects directly to this one. AI infrastructure, the physical computing, the data centers, the GPU networks, is currently the primary driver of market returns in 2026, and it is capturing a disproportionate share of the capital being redirected by younger wealth holders. The overlap is not coincidental. The generation receiving inherited wealth is the same generation that was raised on the internet, adopted smartphones in their teens, and is now treating AI infrastructure the way their parents treated a 30-year fixed-rate mortgage, as the foundational, productive asset of their era. If you want to understand where the $124 trillion ultimately lands, follow the investment preferences of the people who will control it, and they are telling you clearly where they are going. The real estate shift. Real estate is the single largest asset class in this transfer, and it is about to be dramatically reshuffled geographically. For the past 30 years, the housing premium has followed boomer retirement preferences: warm weather, low density, golf courses, Florida, Arizona, the Carolinas. The Sun Belt boom was, in large part, a demographic story. That story is changing. The millennial wealth receiver is not buying a retirement condo in Scottsdale. They are buying in Austin, Raleigh, Nashville, Denver, and Columbus. They are buying in growth hubs, cities with strong tech employment, cultural vibrancy, and relative affordability compared to legacy coastal markets. The real estate investor who is positioned in the path of millennial household formation, not boomer retirement, is positioned for the next 20-year wave. The demographic tailwind is shifting, and the capital is following. Here's something that will change how you read the room in any professional setting. The visible signals of wealth are shifting, and the new wealthy are deliberately invisible. The 2026 version of serious wealth is not a Rolex. It is not a luxury car. It is not a designer wardrobe. Those are signals of the old wealth playbook, consumption as status communication. The new wealthy have figured out that the most valuable thing money buys is not stuff, it is time. Signal 1. Time freedom. When you meet someone who controls their own schedule completely, who never says, I have to check with my boss, who is available on a Tuesday afternoon, who takes a month off without a project falling apart, you are almost certainly looking at real wealth. Not inherited, not borrowed, not performed. Structural. Time freedom is the first and most reliable signal. It cannot be faked sustainably. It cannot be purchased with debt. You either own enough productive assets that your time is your own, or you don't. Signal 2. Narrative insulation. The second signal is what I call narrative insulation. The genuinely wealthy are not anxious about economic news. A market drop does not ruin their week. An interest rate change does not restructure their life. A bad quarter at their employer does not threaten their stability. They are insulated from the narrative, from the daily anxiety machine of financial news, because their wealth is structural, diversified, and not dependent on any single income stream. They read the news with curiosity, not fear. Most people are inside the narrative, hostage to it. The wealth transfer creates an opportunity to begin building the assets that move you from inside to outside. That transition from financially fragile to financially insulated is the actual goal, not the yacht. Signal 3. Investment in health and relationships. The new wealthy are investing heavily in health, not as vanity, but as asset preservation. A body that can work and think at 65 with the energy of 45 is worth more than any financial asset. They spend money on sleep, nutrition, fitness, preventative medicine, and mental performance in the same way they would fund a high-yield account. And relationships. The social capital of the new wealthy is extraordinary. Networks of peers, advisors, and collaborators who create opportunities that never appear in a job posting or a pitch deck. The new wealth formula: time freedom plus narrative insulation plus compounding health plus deep relationships. None of these show up on Instagram. All of them show up in your net worth statement 20 years from now. Before the roadmap, a critical piece of context. If you are in your 30s or 40s right now, you are sitting at the most important financial intersection of your life. Here's why. Your 40s are the decade where peak earning power, the highest salary, the most valuable professional skills, the broadest network intersects with remaining compounding time. You still have 20+ years before traditional retirement age. 20 years of compounding at even modest returns is transformational. The people who use this window, who take capital accumulated from peak earnings and deploy it into the right assets during the wealth transfer, are going to look like geniuses in 2045. The ones who spend their peak earning years maintaining a lifestyle instead of building an asset base are going to wonder where the time went. This is not judgment, it is math, and the window is open right now. Step 1. Skill acquisition in transfer industries. The first practical step is to look at your professional positioning and ask, am I in the path of the capital flow? The industries that will be busiest and most profitable over the next 2 decades are those that service wealth transfer directly. Estate planning law is facing a generational demand surge. Every one of those million-dollar estates needs legal structuring. Tax advisory for inherited assets is a growth field. Financial planning for newly wealthy recipients who have never managed significant capital is exploding. But it is broader than finance. Real estate agents who specialize in the growth hub markets, Nashville, Raleigh, Denver, are going to see extraordinary volume. Healthcare providers in boomer retirement corridors will be in structural demand for 20 years. Senior care businesses, assisted living development, end-of-life financial services. These are not glamorous, but they are in the direct path of the largest demographic wave in American history. Skill acquisition is not about changing careers tomorrow. It is about deliberately building credentials, networks, and expertise in the sectors where the money has no choice but to flow. Step 2. Transition from participant to owner. This is the mental model shift that separates wealth builders from everyone else. Most people spend their entire working lives as participants in someone else's asset. They work for a company. They live in a rented apartment or a mortgaged home. They deposit into a 401k managed by an institution. Participants receive wages. Owners receive returns. The practical version of this in 2026 is every dollar you save should be working toward ownership of a productive asset, a rental property, fractional ownership of a business, index fund ownership of companies generating real cash flows, a skill-based business where you are the asset and the equity accrues to you. You do not need to be rich to start. A single rental unit, a fractional share of a commercial property through a REIT, a small stake in a friend's business. The amount is almost irrelevant at the start. The habit of ownership thinking is the actual asset. Practical target. By the end of this year, own at least one productive asset outside of your employer. 1. It can be small. The psychology of ownership compounds faster than the returns do. Step 3. The $40 trillion spousal transfer. Here is the most overlooked element of the entire wealth transfer story, and I want you to pay close attention to this. Approximately $40 trillion of the total $124 trillion will not pass directly to children or grandchildren. It will pass first to surviving spouses. And because women statistically outlive men by 6 to 8 years, the vast majority of this spousal transfer will land with women who have never before been the primary financial decision maker of their households. This is not a minor demographic footnote. This is $40 trillion moving into the hands of a new population of capital controllers. Most of them in their late 60s and 70s, most of them with limited prior experience managing significant wealth, and most of them actively searching for trustworthy advisors, financial guidance, and community. The business opportunities here are extraordinary. The financial advisory firms, estate planning services, community organizations, and educational platforms that serve this demographic with genuine care and competence are going to be among the most valuable institutions of the next 2 decades. And for individuals, if your professional network does not currently include financial professionals who serve this demographic, you are missing a connection to one of the fastest growing pools of capital in the economy. Step 4. Build before the wave peaks. The transfer has started. It will accelerate through 2030 as the oldest boomers, now in their late 70s, move through their final wealth transfer events. The peak volume of this movement will hit somewhere between 2028 and 2035. You have a window, not forever, a window. The time to plant the flag in growth hub real estate is before the millennial wealth receivers flood those markets. The time to build credentials in transfer-adjacent industries is before every financial advisor in America pivots to serve them. The time to develop the relationships and the asset base is before the competition for those positions becomes intense. The best time to get in front of a generational wave is slightly before it becomes obvious to everyone. I want to close with the framing that I think matters most. Normal is expensive. It sounds counterintuitive, but it is true. Following the normal path, spending your peak earning years maintaining a lifestyle, keeping your savings in a savings account, staying in industries unaffected by the largest capital movement of the century, that path has a very predictable outcome. Not bad, necessarily, but not the kind of wealth that creates time freedom and narrative insulation. Different builds wealth. Not recklessly different, not chaotically different. Deliberately, patiently, strategically different from the financial behavior of most of the people around you. Owning when others are renting. Building skills in growth sectors when others are coasting. Positioning in front of demographic trends that are not yet in every financial magazine. Treating your health and your network as balance sheet assets rather than lifestyle expenses. The $124 trillion is moving. It started moving before you sat down to watch this. Some of it will land with people who are paying attention. Some of it will reshape markets in ways that benefit the patient investor. None of it will wait for you to feel ready. The question is not whether this transfer is real. The question is whether you are building a position to benefit from it. If this gave you something useful, share it with one person in your professional network who needs to hear the spousal transfer piece specifically, because it is the most underreported angle of this entire story, and it will matter enormously in the next decade. Drop a comment below. Which of the 5 action steps are you closest to acting on right now? I read them all, and the responses shape what we cover next. Stay sharp. See you next week.